The odds of a US government shutdown have surged to 83%, the highest level in 2025. And according to Polymarket, by October 1st, there's a 77% chance. The key that you need to understand is, what does a government shutdown mean, and how does this affect crypto? And then overall, what is the macro economy looking like towards the end of this year that we all need to be ready for? Because there's about an 83% chance of a shutdown this year, and 77%, this fluctuates on Polymarket by October 1st. Well, a government shutdown occurs when funding legislation required to finance the federal government is not enacted before the next fiscal year begins. And in a shutdown, the federal government curtails agency activity and services, ceasing non-essential operations, and retains only essential employees and departments that protect human life or property. And the most significant shutdown was a 21-day shutdown from 1995 to 1996 during Bill Clinton's administration over opposition to major spending cuts. And then there was a 16-day shutdown in 2013 during Barack Obama's time in office. And the longest was a 35-day shutdown in 2018 during the first Donald Trump presidency, caused by a dispute over expanding barriers of the US-Mexico border. And the reason why this matters for you is because this creates volatility in the market if the odds of a shutdown are higher. And because they're higher right now, we need to be paying attention to this. Because we got a lot of people on social media saying things like, I can't wait for a government shutdown, because what exactly will America lose? Nothing. Washington, D.C. doesn't work for us anyways. Think about it. Republicans have passed one measly bill this year, and the rest of the time Congress has been on vacation. Meanwhile, the rest of America keeps working, producing, and moving forward without them. The only thing a shutdown will prove is that we don't need Washington, D.C. to survive. It's where the blood-sucking vampires reside. Shut down the whole damn thing. And then Gunther's saying, I'd rather have the government shut down than having my taxpayer money fund illegal aliens and transgender surgeries. And JD Vance is saying Democrats are about to shut down the government because they demand we fund health care for illegal aliens. And the SEC posted this on their website, saying in the event of a federal government shutdown, due to the lapse in appropriations, the SEC's operating status will change concurrently with the rest of the federal government. In accordance with the agency's plans for operating during a shutdown, they are currently preparing for a potential shutdown. So a shutdown by October 1st could begin if no funding agreement is reached by September 30th. So do you guys think this is pure political theater here? Now, as you guys already know, the world's a stage. We've been here before, and government shutdowns is nothing new because of the disagreements over budget allocations. If you've been around the channel for any period of time, you've seen this lady, Janet Yellen, talk about raising the debt ceilings, and every single time they've always raised it. But leading up to the event, it creates a lot of uncertainty here.
More importantly, it's a gun to the head of the American people and the American economy, because a failure to raise the debt ceiling is really saying, if the president and the Democrats don't agree to these draconian cuts, we're going to do something to bring enormous harm to American households that rely on the government and need to have jobs.
So we're going to dive into the charts and show you what's happening. But first, UBS, a massive global financial institution considered the world's largest wealth manager with over 5.7 trillion in assets under management as of March of 2024. Now, BlackRock is much bigger, but UBS has a massive presence with more than 110,000 employees in over 800 locations worldwide. It serves as the largest bank in Switzerland and one of the world's largest private banks, managing a significant portion of the private wealth globally. Well, they recently issued a stark warning assessing a 93% probability of a U.S. recession based on hard data from May to July of this year, using indicators like stagnant industrial output, weak job growth, and declining consumer spending. Although they're not predicting a sudden collapse, but rather an extended period of weak, soggy growth here. And if we look at the unemployment rate, you guys can see when recessions have been marked in, each time that unemployment has spiked up in the past, going all the way back to late 1940s. Every single time unemployment has gone from like 2-3% and drastically risen up to 5% or higher, these gray vertical rectangles here are when recessions are marked in. And so right now, what we're seeing here, if I just zoom in for you guys, is the unemployment rate rising up from April of 2023 from 3.4, and currently August just came in at 4.3%. Now, in my previous videos, I played clips from Jerome Powell where he talked about how 4.4% is where the Federal Reserve is watching, and anything above that is recession territory. And so we're heading there, and I've said this many times, it's not a matter of if, it's pretty much a guarantee. 93% odds, I think they should put it at 100% odds. It's just a matter of when that recession gets marked in on here, because it's inevitable. Every single time, 100% of the time in the past, 100 years, we've had periods of low unemployment and high unemployment. So when we go to high unemployment, by then it'll already be too late and you need to be prepared for this, because with inflation staying well above 2% and now climbing back up again with the Federal Reserve lowering interest rates, this is not going to help inflation. So the cost of goods and services in the store, food is going to get more expensive, and gone are the days of low inflation. I mean, go all the way back to 2015, 16, when we were at 0.2. The only other time that we've been that low was April of 2020 and May of 2020, because after the 2021 surge, the Federal Reserve has not been able to lower inflation back down below 2%. So they couldn't even get to their 2% target. The best they did was 2.3%. And now that they're lowering rates, expect inflation to climb back up. And the effective federal funds rate is going to directly affect the 10-year to 2-year yield curve as well, too. Now, I want to explain what this means, because we just got out of this yield curve inversion, and now we're in positive territory at about 0.57, which is 57 basis points. And if you look on the chart here, when recessions were marked in with these vertical dark gray rectangles here, the previous one was right here, February of 2020 to April of 2020. And that was during the COVID pandemic, when unemployment spiked from 3.5 to the highest level since the 1950s, even before then. We were all the way up here, almost at 15. The time before then was between December of 2007 until roughly July of 2009. That was when the yield curve was at about 1 to 2.42. The time before then was March of 2001 until November 2001. The yield curve was at 0.75 to 1.94. The time before then was July of 1990 to March of 1991, when the yield curve went from about 0.45 to 1.03. And so the past 4 recessions going back to the 1990s happened after a yield curve inversion and during an increase in the yield curve. So when we see a positive spread at 57 basis points, which is 0.57, where we're currently at right now in positive territory, it means that the 10-year yield is higher than the 2-year. And this typically suggests that investors expect higher inflation in the longer term compared to the near term, which is what I just mentioned about the inflation rate right here. It's rising up. It's at 2.9. I'm expecting this to increase over the next 6 to 12 months, because the 10-year yield reflects longer term expectations, while the 2-year yield is more sensitive to short-term monetary policy and economic conditions. And when Grok was asked to make an educated guess about where the yield curve will be by December of 2025, Grok is predicting that the Treasury yield spread will widen modestly to around 0.75% or 75 basis points by December 31st, driven primarily by the anticipated Federal Reserve rate cuts that disproportionately lower short-term yields compared to longer-term ones. So this is based on Fed policy expectations, broader economic outlooks. So if artificial intelligence is predicting a widening of the yield curve to increase from 0.57 to 0.75, in the past 1, 2, 3, 4, even the 5th and the 6th one going all the way back to 1980, so 6 for 6, a recession has been marked in while the yield curve widens, well then those are pretty strong odds of another recession getting marked in, which is why UBS, one of the world's largest with $5.7 trillion in assets under management, gave a 93% probability of a recession. Now, if we look at Bitcoin's price chart right here, compared to the 10-year to 2-year yield curve in blue, you can see that down here at the bottom of the screen, where you see this little red backdrop color, that's when the yield curve was inverted below 0. So on the left-hand side of the screen, you can see where the yield curve percentage is. And you can also see on the right-hand side of the screen where the price of Bitcoin is at around $109,474. So if we go all the way back to the last time that the yield curve topped out all the way up here in December of 2013, based on this chart, it was actually higher than that. On February 4th of 2011 at 2.91,